Imagine returning home with enough silver to support your family for the rest of your life. There is only one problem. There is no bank. You are an Assyrian merchant nearly 4,000 years ago. Your donkeys have crossed hundreds of miles carrying textiles and tin into Anatolia. After paying guides, tolls, partners, and local rulers, you have converted the cargo into silver. The metal on your table represents years of dangerous journeys. Now you must decide where to put it. Leave it in the house, and a thief needs only one night to erase a decade of work. Carry it, and every stranger can become a threat. Bury it beneath the floor, and war or illness may prevent you from returning. Give it to a temple, palace, or trusted merchant, and you exchange the risk of theft for the risk that an institution or another person will betray you. You could buy land, but land cannot flee an invading army. You could buy animals, but animals become sick, require food, and sometimes walk away. You could lend the silver to another caravan and ask for a return, but the road that made you rich could destroy your savings just as quickly. A modern saver sees a number inside an account. The ancient saver saw grain, animals, metal, property, documents, and people. Saving was not one action. It was the art of choosing which danger you were most willing to face. This is the part of financial history hidden by the bank vault. Long before regulated accounts, deposit insurance, or even minted coins, human beings already understood the basic problem of saving. Production and need do not arrive at the same moment. A harvest comes once, but a family eats all year. A merchant earns a fortune on one voyage, but may not trade again for months. Parents accumulate wealth while they are strong, so children can inherit it after they are gone. Saving moves value through time, but time attacks almost everything. Food rots, cloth tears, houses burn, animals die, metals are stolen, rulers confiscate property, records disappear, trusted relatives become untrustworthy. Even the meaning of value can change between one generation and the next. The first saver did not ask which account paid the best rate. The first saver asked what could survive. For early farming households, the most obvious answer was grain. Agriculture produced a new kind of economic problem. A hunter could use what was caught. A farmer might collect far more food in a few weeks than the household could immediately consume. That surplus had to reach the next planting season. Some of it would become meals, some had to remain untouched as seed, some might be exchanged, offered, paid as rent, or kept for an emergency. The granary became one of humanity's earliest machines for carrying wealth into the future. Its walls did not merely hold food. They separated abundance today from survival tomorrow. Yet storing grain was expensive. It had to be dry enough to resist mold. Containers and rooms had to limit insects and rodents. Guards, doors, and seals had to discourage theft. Somebody needed to measure what entered and what left. Old grain had to be consumed before it failed, while enough new grain remained for seed. A sack in storage was therefore not equal to a sack in the field. Storage consumed labor, buildings, and attention. Losses were unavoidable. The longer grain remained, the greater the chance that part of it would disappear into pests, moisture, spoilage, or dishonest hands. This created the first economics of saving. A household had to save enough to survive a bad season, but not so carelessly that its reserve decayed unused. Holding too little created hunger. Holding too much in a fragile form could waste labor that might have been converted into something more durable. Grain was a powerful short-term reserve and a weak long-term fortune. Ancient Egyptian evidence captures this contradiction. Grain was measured into granaries, recorded by scribes and used to express value before coinage became ordinary. But grain could not sit safely forever. It was meant to circulate into bread, beer, seed, and wages. The reserve survived because administrators continually moved it, not because they locked the door and forgot it. Saving did not always mean refusing to spend. Sometimes it meant controlling the rate at which a resource was transformed. The saver gained security by concentrating wealth. Concentration made the wealth easier to govern and easier to seize. If grain was too fragile, living animals offered another possibility. A herd was wealth that could eat, move, and reproduce. Sheep supplied wool, milk, meat, hides, and offspring. Cattle provided labor, food, status, and future animals. Goats could survive on difficult land and be divided among heirs or exchanged when a household needed something else. An animal did not simply wait to be consumed. Properly managed, it generated a flow of products while remaining an asset. This made livestock one of the most remarkable savings technologies in history. A jar of grain becomes smaller when a family eats from it. A healthy flock can become larger. But growth was never automatic. Animals required grazing, water, shelter, and human attention. Disease could destroy wealth that had taken years to build. Drought could force many families to sell animals at the same moment, pushing prices down precisely when cash or grain was most urgently needed. Predators and raiders saw the same mobile value as the owner did. Livestock were portable savings, but they were portable for thieves too. They also converted financial wealth into social power. Animals could be given at marriage, offered in ritual, lent to relatives, exchanged for labor, or displayed as proof that a household commanded land and people. Their value did not come only from meat. A large herd could create alliances, obligations, and prestige. Land offered a different answer. It could not be carried away in a sack. A field could produce grain year after year. An orchard might provide fruit and oil. A house could shelter a family, hold workshops, and establish membership inside a community. Rights to water, pasture, or future rents could support descendants long after stored food was gone. For the wealthy, property was a savings account that paid in harvests. Its strength was also its weakness. Land survived many kinds of physical loss, but ownership survived only when society recognized the claim. A tablet, boundary stone, witness, inheritance, custom, or ruler had to say the field belonged to this household and not another. If an army took the city or a king redistributed estates, the earth remained while the owner's wealth vanished. Property could not be stolen quietly. It could be taken officially. Land was also difficult to divide and slow to sell. A family needing food tomorrow could not always find a buyer for one corner of a field today. A bad harvest reduced the income of the asset at exactly the moment the owner needed reserves. Taxes, rent, and labor obligations might continue even when production failed. The safest store of value in normal times could become a trap during crisis. This difference between wealth and liquidity mattered long before economists had those words. Wealth is what a person owns. Liquidity is how easily that ownership can answer an immediate need. A landowner could be rich and unable to buy dinner without borrowing. A herder could own 50 animals but be reluctant to sell breeding stock. A household might possess linen, tools, and furniture worth far more than the grain it needed, yet lose heavily if forced to exchange them in desperation. Ancient savers learned that value had to be held in more than one form. Grain handled ordinary months, animals provided products and growth, land generated future harvests, tools produced income, jewelry and metal covered emergencies. Relationships opened credit when assets could not be sold quickly. Diversification was not invented by a modern portfolio manager. It was visible in every household that refused to trust its survival to a single harvest. Metal solved many weaknesses of agricultural savings. Copper, silver, and gold did not need to be fed. They occupied little space compared with grain. They could be weighed, divided, melted, and carried across long distances. If people trusted the quality, metal preserved purchasing power far beyond the life of a crop. This did not require coins. Ancient people used rings, bars, vessels, jewelry, ingots, and cut pieces of metal. Value came from weight and purity rather than a stamped denomination. A merchant receiving silver might place it on a balance, test it, and compare it with a known standard. Metal allowed savings to become dense. Years of surplus could fit inside one jar. That density transformed the problem of security. A granary was difficult to move and difficult for one thief to empty unnoticed. A bag of silver could disappear beneath clothing. The more successful metal became as a store of wealth, the more attractive it became to steal. Protection required concealment, guards, or trusted custody. Many households chose concealment. They placed valuables beneath floors, inside walls, under courtyards, in caves, or within containers buried in the ground. During invasion, revolt, or personal danger, hiding wealth could be the fastest available defense. The earth charged no fee, asked no questions, and did not reveal the owner's name. It also offered no customer service. A buried cache depended on memory, secrecy, and return. If the owner died without explaining the location, the savings left the family. If a building changed shape, a market disappeared, or the household fled permanently, hidden wealth became economically dead. Every ancient hoard discovered by archaeologists contains this tragedy. Some caches may have been ritual offerings, metal stock for craftsmen or collections assembled for other reasons, but many were clearly protected wealth. And the ones found centuries later share one fact: the person who buried them did not successfully recover them. The objects survived. The saving plan failed. This makes archaeological evidence deceptive. We see the ancient treasures that remained hidden, not the far larger number that owners dug up and spent as intended. A hoard does not prove everyone buried wealth. It proves that concealment sometimes protected valuables from the immediate crisis, while separating them from the people they were meant to protect. Secrecy reduced the risk of theft and increased the risk of loss. The best hiding place was one nobody knew. The worst inheritance was one nobody knew. Jewelry offered a compromise between hiding and carrying. Gold and silver could be shaped into rings, bracelets, pins, necklaces, and decorated vessels. The object displayed status during ordinary life, traveled with its owner during danger, and could be weighed or remade when the household needed value in another form. Wearable wealth was especially important because property rights were unequal. In many societies, land and large businesses were controlled primarily by men or by extended families. Marriage payments, gifts, textiles, and personal ornaments could give women a more portable claim within household wealth, though their actual control varied enormously across time and place. A necklace might be beauty, status, ritual object, inheritance, and emergency reserve at once. Its multiple purposes made it efficient. The household enjoyed it without destroying the metal, yet craftsmanship complicated resale. A buyer might pay for weight and ignore the labor that created the design. Melting an heirloom could preserve its material value while erasing its social meaning. Ancient savings were rarely just financial. They carried memory. For rulers and elites, the scale of the problem was much larger. A palace receiving tribute, tax, and war booty could accumulate grain, metal, weapons, textiles, and precious objects from entire regions. Temples also received offerings, controlled estates, employed workers, and possessed strong buildings protected by religious authority. These institutions became natural repositories of wealth. But repository does not automatically mean bank. Some property stored inside belonged to the institution itself. Some had been dedicated to a god and could not be treated as an ordinary customer's balance. Some arrived through rent, tax, or tribute rather than voluntary deposit. Temples and palaces could safeguard valuables, maintain accounts, make loans, and invest in trade, yet the combination differed across periods and cities. The important development was custody. A saver no longer had to choose only between carrying wealth and hiding it at home. Value could be placed inside an organization with walls, guards, officials, seals, and records. Custody separated ownership from possession. That separation was revolutionary because it made wealth easier to protect and easier to manipulate. A claim could sometimes be transferred or used to settle an obligation without moving the underlying goods. A merchant away from home could communicate with partners who held silver, textiles, or debts on his behalf. Families could track investments across cities through letters and tablets. The savings began to exist in two places: as an asset in storage and as information about who had the right to it. Information created new risks. A stolen jar was obvious. A false account could redirect wealth while leaving every jar untouched. A dishonest clerk might alter a quantity. A damaged tablet might erase evidence. A seal could be challenged. Heirs might disagree over what the dead owner intended. The stronger the financial system became, the more it depended on trusted records. Ancient Mesopotamia developed tools for this long before modern banking. Transactions could be written on clay and enclosed within another layer of clay impressed with seals. Witnesses attached social knowledge to the document. Household archives preserved loans, investments, letters, and disputes. The clay did not protect the silver physically, it protected the claim legally. This allowed saving to escape the limits of objects. Consider the old Assyrian merchants whose caravans linked Ashur with Anatolia in the early 2nd millennium BCE. Their tablets tracked silver invested in tin, textiles, and other goods, along with donkeys, fodder, guides, fees, and final balances. Wealth moved through family firms and partnerships over journeys lasting weeks. A successful merchant did not necessarily keep his fortune motionless. He sent it back onto the road. Silver became textiles and tin. Those goods became distant sales. Sales created new silver, debts, and shares owed among partners. A clay account might represent more wealth than the metal presently inside a house because part of the fortune was moving with a caravan and part was promised by other people. Saving had become investment. The distinction is simple but dangerous. Hoarding tries to preserve what already exists. Investment exposes value in the hope of producing more. A metal cache avoids commercial risk but earns nothing. A trading venture can multiply wealth but may be destroyed by bandits, weather, political conflict, dishonest agents, or collapsing prices. The saver who wanted growth had to surrender control. The fortune left home before the profit could return. This created a financial question still familiar today. How much of the reserve should remain safe, and how much should be placed at risk? An ancient merchant needed working silver for trade, emergency supplies for the household, assets that protected status, and enough liquidity to answer debts. Investing everything could make him richer. One failed caravan could also leave his family with tablets, proving that lost goods had once existed. The smartest saver was not always the boldest trader. It was the person who could survive being wrong. Lending offered another way to make savings productive. Surplus grain or silver passed to a farmer or merchant and returned later with an additional payment. The lender escaped the cost of guarding the asset but accepted the borrower's risk instead. A drought could damage grain, herds, land income, and debts together. One person's reserve became another person's opportunity, yet several forms of wealth could still fail in the same crisis. This is why political and social relationships were part of the savings system. A household invested in relatives, neighbors, religious obligations, and patrons, because no object could answer every crisis. Gifts created expectations. Hospitality established reciprocity. Supporting a child, sibling, or trading partner might produce no written interest, but it built a claim that could be called upon later. Trust acted as an emergency fund stored in other people. It was valuable precisely because it was not exposed to the same physical risks as a granary or herd. The state could protect wealth by enforcing ownership and punishing theft. It could also become the greatest threat to savings. Taxes claimed stored grain. Officials inventoried land and animals. Armies requisitioned supplies. Conquerors looted temples and palaces because those buildings concentrated the treasures of a region. The largest ancient vaults attracted the largest ancient thieves. Religious protection worked only while attackers feared the god, the community, or the political consequences of sacrilege. Palace protection worked only while the dynasty survived. A storehouse secure from an ordinary robber could be emptied legally by a new ruler. There was no deposit insurance above the king. Families responded through division. Some wealth remained visible and productive. Some became portable. Some was hidden. Some was placed with another person. Some was invested in children, marriages, and land that confirmed the household standing. This was not a perfectly planned portfolio. Much of it emerged from custom, necessity, and inequality. But the economic logic is recognizable. Never place the entire future in one container. The poor had far fewer choices. A wealthy merchant could decide between land, silver, loans, and caravans. A laborer might save a tool, a little grain, a goat, cloth, or a claim for unpaid wages. The reserve was the same thing required to earn income. When crisis forced the sale of a tool or breeding animal, the household did not merely spend savings, it damaged its ability to recover. This is the cruel difference between consuming a reserve and liquidating productive capital. Eat stored grain, and next month's food declines. Eat the seed, and next year's harvest disappears. Sell a goat, and the household loses future milk and offspring. Pawn a tool, and the artisan loses the means to produce. For people near subsistence, saving was not about retirement. It was about preventing one bad week from becoming a permanent fall. The wealthy used savings to purchase time. The poor saved to avoid selling the future. Inheritance extended the problem beyond one lifetime. Wealth had to pass not only through years but through death. Land boundaries, marriage contracts, wills, witnesses, and family archives identified who received what. Jewelry and household objects could be divided physically. Claims, businesses, and fields required agreement. A fortune without a clear successor invited conflict. Records therefore became part of the asset. A field with recognized title was worth more than land surrounded by dispute. A debt supported by witnesses was stronger than a private memory. A sealed account allowed a family to continue business after the person who created it was gone. Ancient finance was slowly learning that durable wealth required durable identity. The object had to survive. The owner's claim had to survive too. Coins eventually improved one part of this system. Standardized pieces of metal made small payments faster and reduced the need to weigh and test every exchange. They helped governments pay soldiers and collect revenue. They made portable savings easier to count. But coins did not solve storage. They could be clipped, debased, stolen, hoarded, or lost. Their purchasing power changed with metal supply, taxation, war, and political trust. A chest of coins remained a physical object, vulnerable to every person who could reach it. Coins made wealth more liquid. They did not make it safe. Bank-like institutions emerged by attacking that remaining problem. Temples, merchants, money changers, and private financiers could accept valuables, keep accounts, transfer payments, and make loans. In some ancient cities, specialized bankers operated long before anything resembling a modern, regulated bank. The decisive change was not a stronger box. It was a stronger claim. When a saver trusted an institution, the institution could hold the metal while the saver used an account or receipt. If that claim could be transferred, payment no longer required the owner to carry the treasure through the street. If many savers placed funds with the same intermediary, some of the stored wealth could finance loans and trade. The vault protected physical value. The ledger made it economically active. This produced a new danger. A visible jar can be checked. An account depends on the keeper's honesty and solvency. If an intermediary lends too much, loses records, fails in business, or disappears, several savers can lose together. Private safety becomes institutional risk. The saver no longer needs to fear every household thief. The saver needs to fear the collapse of the custodian. Modern banking would spend centuries building legal identities, audits, capital requirements, central banks, and deposit guarantees around that problem. None of those protections is perfect. They exist because the ancient question never disappeared. Who guards the surplus while its owner is not using it? Before banks, the answer might be a wall, a floor, a herd, a relative, a temple, a document, or the owner himself. Each solution charged a different price. Grain lost value through decay. Animals demanded labor and faced disease. Land sacrificed mobility. Metal attracted theft. Burial sacrificed access. Custody required trust. Lending risked default. Investment risked the entire venture. Relationships created obligations that could not always be enforced. There was no perfectly safe asset because saving is an argument with an uncertain future. The merchant at the beginning of this story therefore does not make one choice. He keeps silver for immediate obligations. He places part with a trusted partner. He invests part in the next caravan. His household holds textiles, tools, and grain. His family may possess land, animals, and jewelry. Tablets record what others owe and what shares belong to relatives. His fortune is not inside a single ancient vault. It is scattered across objects, people, places, and promises. That scattering looks inefficient beside a modern account, but it gives the household a chance to survive different disasters. If grain spoils, silver remains. If metal is stolen, land may still produce. If trade fails, the herd may grow. If the owner dies, records and relatives may preserve some claims. Saving before banks was less convenient because security could not be outsourced to one institution. It was also more honest about what wealth really is. The ancient saver had no screen showing a stable total. Wealth changed shape constantly. Harvest became grain, grain fed workers, labor produced textiles, textiles crossed mountains, sales became silver. Silver became loans, land, animals, or another caravan. A family remained secure only if enough value completed that journey and returned when needed. Saving was movement disguised as stillness. Even treasure buried in the ground was waiting for a future transfer. Banks eventually gathered the strongest parts of these methods into one system. They offered guarded storage, permanent records, transferable claims, access to credit, and a legal institution that could outlive an individual custodian. Their great promise was not that wealth would become free from risk. It was that ordinary people would no longer have to manage every risk alone. Before that promise, every surplus created a private dilemma. Consume it now, and tomorrow may bring hunger. Preserve it badly, and time will consume it for you. Hide it too well, and your heirs may never find it. Place it in another person's hands, and your future depends on their character. Send it into trade, and growth demands exposure to loss. The ancient world discovered that producing wealth was only half of prosperity. The other half was making sure value reached the moment for which it had been saved. That was the economics of saving before banks.